This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Hey, everybody, and thanks for tuning into The Wealth Puzzle. I am slowly waiting for Tana to start laughing here.
Right there.
Oh, there we go. On cue. Get the laugh every single week. But hey, we just want to say thanks for everyone tuning in. We are The Wealth Puzzle. We are the Lynn Group here. We focus on retirement income planning. For the lucky viewers, though, so, we got a lot of people listen to the podcast, but we now have, the lucky viewers on YouTube and Rumble. So the people that are viewing this, if you're watching this right now, you notice something. You notice that my hair has grown out and my beard. And I'm, in fact, a little taller.
Oh, dear.
Just kidding. That's Connor, right?
There's three
Connor's
of us.
here. Connor is here.
Yes.
So who's Connor? Oh my gosh. Rapid expansion around here. We're hiring people daily and we just need to pop them on here. So Connor, he's been around for years. What's it been? 15 years, Connor?
Something like that. Feels like it.
That would make you 9 when you started working here.
Right.
Yeah. So Connor is our in-house tax professional. He prepares all of our clients' taxes. But that's the boring part of the show. The most important part, he does all the tax planning. He meets with our clients. He strategizes with our clients. He discusses the things they should or shouldn't be doing from a tax standpoint. Because guess what? There are some things that you can do inside of a calendar year in order to make your taxes more efficient. Yeah. And most people flub that. Most people wait until like March 15th.
Yeah.
Say, I got to get my taxes done. How do I save some money? Well, maybe last year you should have done something.
Right.
Thought about it. You should have not sold that thing, or you should have done it this way. Connor is the guy for that. So if you hate your tax preparer, which statistically most people do, then you should come talk to Connor. Right?
Yes,
Boom.
I agree.
So
he's
hey,
amazing.
that's why Connor's here. So anyways, a couple weeks ago, Tana and I did a show. And we were talking about some child tax credits and things like that. And Connor actually listened to the show, and he solely did it for a point of criticism and came back to me and told me, why are you talking about that stuff when I could do it better?
Exactly.
Thought, well, that's the problem with being a micromanager is you have to do everything yourself. So we decided that it's time for Connor to get on board. So Connor is here. Connor, I'm excited to have you because you're going to talk about some hot things. We're going to talk about, I think, some stimulus payments. We're going to talk about some tax credits. It really speaks to the nature of human minds, right? That the three of us are sitting here excited to talk about this stuff when so many people wouldn't be so. So anyways, all right. So Connor created a PDF. Now, granted, remember, Connor's a tax guy. He's a numbers guy. He's a spreadsheet guy. So there is no fluff on this PDF. There are no pretty pictures. There is no, pretty fonts or anything. This is just down to business, nitty gritty tax.
And he's very thorough.
Connor.
All right. You guys
ready? What do you
ready?
have for us? We're stoked.
Okay, there's 5 main things that I wanted to talk about during this podcast episode. Different tax changes between last year and this year, new credits that were added into tax law, and just all around some good stuff for us to know. None of it is overly complicated, but it is a good talking point and good for planning to the future. A lot of this stuff has AGI limitations and things like that we really need to plan for before the end of the year, like Mike had mentioned. I kind of put them in order into what I thought our clients would most appreciate. So I started with the advanced child tax credit. We have many clients who are retirement age, but also many that have kiddos and are still claiming these credits. They changed child tax credits this year. So you still do have your $2,000 a child base credit, but they've added on a bonus credit. So for kids, go ahead.
I was just gonna say woohoo.
Woohoo.
I just wanted to get my woohoo in there.
Oh yeah.
All right. So for kids over 6, we have a $1,000 bonus credit. This is subject to $150,000 AGI limitation. So possibly planning around keeping that AGI on the lower side of that could save you a bit of money there. If you got kiddos under 5, we're looking at a $1,600 credit. So it's about $600 more for those younger kiddos, and that has the same AGI limitation. Those are powerful. This is the first year they put those into tax law. We expect them to stay there for a little while longer at least, but this is Biden's change to tax law. These credits, they're a little bit strange this year. So they started paying them out in July of this year. So July 15th was the first payment, and they're actually doing them as a monthly stimulus as opposed to an end of year tax credit. And that's a big deal. So because we're receiving them in advance, and there's a way to opt out through the IRS website, but because we're receiving those guys in advance, we have to be very keen as far as what we're looking at the end of the year. If you guys are receiving your tax credits as we go on a monthly basis, you're not going to have that big credit at the end of the year when you're used to it as you file your tax return. And that could be worrying.
Okay, so people could owe tax because they're getting it differently. Now, I'm just screwing with the math here for a second and just giggle's sake. So a family of 4, if you had 2 kids over 6, 2 kids under 6, what you're saying here on this fancy piece of paper is that people would be getting after this year $1,100 a month in tax credits.
Let's see.
So you got 300, 250, 250.
Yep.
Is that right?
Yep. $1,100 a month.
So $1,100 a month. That's
money.
over $13,000 a year cash flow. You could get yourself a Range Rover with $1,100 a month. You could, you could prepay your cruise to Rome or whatever for $1,100 a month.
Oh dear.
That
You could throw it into a savings account for the kiddos, a nice college savings account.
That's a great idea.
How do we eject Connor from this conversation?
No.
This is America, Connor. We're not here to talk about responsible things.
Right.
We're here to talk about reality, and reality is someone's buying a Range Rover with this.
Let's hope not.
It'll happen. We know it will.
Too much faith.
Yeah.
Well, that's fascinating.
Yeah, so 2021, we get about 6 months of the credit. We get the other half when we file our taxes. But in 2022, the entire credit is going to be coming to us as a monthly stimulus. So that's something that we want to plan for. If your withholding hasn't changed and you're used to being just about break even, you're likely going to owe tax when you file your tax return if you're used to receiving these credits. And that's scary. I mean, Mike just said $13,000. Like that is a lot of money to have to pay back if you end up getting it in advance. And that's another part of this, right? This is subject to AGI limitations. So if you break that $150,000 cap, you have to pay back the credit that you received. If you receive too much, you have to pay it back. Yep.
So they're pushing this out to everybody, no matter what your income is. Almost, I feel like everybody I know, because we know a lot of people that make different amounts of income, but everybody seems to be getting their letter and getting their check.
Wow.
And,
so the reason everybody's getting their check is because that base credit, that $2,000, is still available to pretty much everybody. As long as you're underneath that 400K AGI, you get your monthly. Yeah.
You're terrible.
I'm jealous.
Whatever.
Terrible.
I wish.
So most people, they are getting that monthly payment just off the base credit. You know, if last year was a lower income year for you and you were underneath that 150 and they're paying you too much, expect that clawback because it'll get you at the end of the year. You're going to have to pay back that credit.
Gosh. But in a separate note, this is very interesting because this is a huge fundamental shift from financial planning, tax planning, and also just kind of a societal rhetoric, right? I mean, this is probably the first time where we're really looking at kind of like a universal income for people. You know, if you have children, the government, you know, granted, there's always been different levels of welfare, but I'm hard pressed to think someone who makes 150 grand is eligible for welfare. So this is becoming a kind of just a monthly universal income, but it has consequences. And I think that's the biggest takeaway I heard from you, Connor, is that people were maybe getting some of this money previously, but they were using it to offset any potential tax liability that they had. So they're going to end up owing that money, even though they got their monthly Range Rover check.
And you have to keep track of these payments when you receive them too, because you're supposed to declare them on your tax return.
That's
so
interesting.
Is there a way that you can log into your IRS account and it shows you the payments that you've received?
Yeah. So in order to go into your IRS account, you would need to make an account with the IRS
Okay.
online. It's not a terribly horrible process, but there have been some quirks with different clients as far as getting those accounts set up. So if you're expecting to have to go through your record, I would go ahead and get that account set up quickly so that you can resolve any issues before tax season.
Okay.
But you're right, Tana. This is something we want to go ahead and keep track of throughout the year, the payments that you're receiving, because it's all reconciled at the end on your tax return.
Okay.
And do you think they would send you a separate tax form for this stuff now?
I don't think that it'll be a separate tax form because this is a credit. It's not income. So we don't pay any tax on the credit.
Yeah, because they didn't send you one for your stimulus check.
They did, but they did a really poor job at sending it out. Those letters that you guys got. So the first one was from Trump. The second two were from Biden. Those served as your tax forms that you were supposed to bring to your tax preparers. But they never mentioned anywhere on there that you were supposed to retain them. So it was a whole mess last tax season. It was rough.
Normally the credits show up on your tax return, which is pretty straightforward, pretty easy. You process that at the end of the year. Now we're processing income every month. We're mailing checks to people. We're depositing checks. We're debating this. Boy, what is it would be fascinating to understand the cost of a program like this. It's just one more layer of what the hizzy is going on.
No, I don't even know where to begin. And like I said, this is not that I don't like work. I love working. I love what I do. But this does create a lot more work at the end of the year for the tax preparer because all of a sudden we have to track down these payments. We got to make sure we have everything right.
Now you got to charge more. So now that factors into the net return for these people.
Definitely.
That's what I was trying to get at.
Isn't there a scenario where if someone doesn't have any income, they're limited on how many credits they can get normally? Like if they didn't pay tax, and you had a bunch of tax credits on kids, could you recoup all of that money as a refund?
In the past, there was part of the tax credit was refundable, which is a credit that comes back to you even if you don't have any tax liability.
Right.
And part of it was non-refundable. And a non-refundable credit means that if you don't have tax liability, that's fine, but you just don't get to take advantage of those credits. So as far as the bonus on this, I don't know how it has changed. That's something that definitely could be researched a bit more to really get the answer as far as if they can get these credits without that income.
Wow. Wow, that's fascinating. Only more motivation to have children, everybody. Adopt kids, borrow kids, buy kids. The more socials you can accumulate on your tax return, it sounds like the better. And be partial when stealing children from Target to get ones under the age of 6.
That is terrible.
I think a kid costs a bit more than $3,600 a year, though.
Yeah, definitely.
Not at my house.
Well, when they get older.
Mine do.
When they get older, they get more expensive.
Mine are expensive.
Is that what it is? So anyways, maybe next they should have give a 16-year-old a free car program. That'd be better.
Oh, dear.
No. Make them work for it.
All right. What else do we got? We got to get down to business here.
All right. Second one, that's the economic impact payment 3, also known as your stimulus number 3. We did have stimulus number 1 and number 2 reconciled on the 2020 taxes, but stimulus number 3 is going to be reconciled on 2021. This payment was supposed to be based off of your 2020 tax returns AGI, but if you filed your return late, it would have been based on 2019. If you didn't receive enough of this credit based on your 2021 income, you can actually reclaim the rest of it on your 2021 taxes. It's called the recovery rebate credit. So this is another one of those things. You need to keep track of the stimulus number 3 that you received and bring that info to your tax preparer when they do your return next year, because this is reconciled once again. Now, this credit's a little bit different than the child tax credit because this one has no clawback. So if you receive too much of a stimulus number 3, they're not going to ask for it back. But if you receive too little, you can go ahead and claim whatever else is due to you when you go to file your tax return.
Wow. So you're saying that if someone made over 150 grand, the limit to get this $1,400 credit, they shouldn't necessarily have gotten all of it. But if they did, based on another return or something, they could still keep all of it.
Yep. Yeah. So if, for example, you had like 140 grand on your 2020 taxes and you made 200 grand in 2021, there's no clawback there.
Only in America would that be the case? Like, why wouldn't they claw that back if they said, "Oh, hey,
Yeah, I think that the stimulus was just rushed out so quickly, and there wasn't a whole lot of legislative planning. That's just the way they had to do it to make it a little bit cleaner.
This is stimulating all of them.
Last tax season, it was rough, and I think that if we would have had clawbacks as well, it would have really killed us. So
yeah,
at least we don't have to worry about that part.
Yeah.
But that's another one of those things. We got to keep track of it. We got to bring it to our tax repairs at the end of the year because it's all reconciled.
Wow. And same answer here. Like you said, Connor, it looks like you need everyone to make sure they're keeping track of these things. It needs to be filed. It needs to be returned. So is there a scenario, what you're saying is some people might have only gotten a partial payment and they can use that recovery thing to get it all?
Exactly. So if for some reason your 2020 AGI was higher than that 150 and you received either a partial credit or no credit at all, but in 2021 your income was below that 150 threshold, all of a sudden you can claim whatever else is due to you. So this is one of those things. Maybe tax planning would make sense. We have 4 more months of this year. Maybe we need to see what we can do to keep our AGI under that 150, whether that's business expenses, you need to talk to your guy about some IRA contributions, whatever we can do to get that AGI down below that threshold to make sure you get your credits.
Very good.
Next thing, unemployment. So last year, unemployment tax had a big change on March 19th. I'm trying to remember the name of the act. It was the American Rescue Plan Act. So it excluded up to $10,200 of unemployment from a tax return's taxable income, subject to AGI limits. I believe that AGI was also 150 grand, ironically. California has a whole nother set of laws there. California doesn't tax unemployment. So that's nice. But because we're a community property state, we were actually able to spread that $10,200 between both spouses. So you were actually able to claim up to $20,400 in exclusion. It was a big deal.
That's weird.
Yeah,
so federally, unemployment is taxed as income. And what happened is if you've been collecting unemployment for 2020 or for 2021? For 2020.
That was 2020, yeah.
And if you collected it, they would exclude a little over 10 grand of it as taxable income. So for clarity, they gave you tax-free income on your unemployment. They gave you stimulus checks. They're advancing you child tax credits.
Wow.
So, dude.
No, this was a big tax savings too. $10,200 in excluded income. For a standard 22% marginal return, that's over $2,200 in tax savings. Wow. So that was a lot. If you spread that between 2 people, you're now looking at $20,000. That's close to, what would that be? $4,500 in tax savings.
It's incredible.
So that last minute tax law that they threw in there mid-March, that saved a lot of people a lot of money.
Yeah, but it sounds like it gets confusing because now you got to overlay state law that doesn't always jive with federal.
Yeah, there are different laws in different states, and the way the federal looks at each state's a little bit different. But most of our clients are California based, so that's where this is coming from.
Yeah,
interesting. But what will happen for this calendar year, do you think, with 2021?
So far, there's no talk about having the same exclusion for unemployment benefits in 2021. So I, as of now, I'm expecting all of unemployment benefits received in 2021 to be fully taxable on the federal level.
We'll change all that about a week before taxes are due next year.
Please, no, not again, not again.
Hang on.
Yeah, no, that was very painful last year. No, so for now, I'm not expecting them to implement that exclusion. Things are a little bit more organized now. There's not, we still do have the pandemic, but it's a little bit more organized now. I'm not expecting that exclusion for 2021, and that brings us to a good point. A lot of clients did not have enough withholding on their unemployment benefits. The first reason is because California does a terrible job at withholding. So even if you're in the 22% bracket, I was seeing 5 and 6% withholding, which is devastatingly low.
Right.
So there was a lot of tax returns last year that received unemployment and also had a pretty big tax bill that they weren't expecting. So making sure that we have unemployment coming out or withholding coming out of that unemployment.
Yeah. And
then if needed, send in an extra payment if you're going to owe tax, just to make sure you get that in, and that way April's not quite so painful for you.
Are these the kind of things that this kind of income that if the withholdings are too low, would this also create an underpayment penalty for these people?
Yeah, exactly. So when you don't pay enough tax throughout the year, general rule of thumb is 90% of your total tax balance. You do end up with what's called an underpayment penalty.
Yeah.
Wow.
So if you don't pay enough tax throughout the year, the IRS and California both assess a little penalty. It's normally based on interest rates, normal interest rates. So they can be range anywhere from $20 to I've seen all the way up to $400. But normally the higher end is for a higher income earner.
Yeah.
So those creep up on you. That's a lot, and most tax preparers don't really talk about them. They just kind of bake them into the cake on the return. But I like to avoid every penalty possible on returns. I hate
absolutely.
paying penalties. So a big part is exactly. A big part of it's just planning and making sure we get enough in throughout the year.
Yeah.
APTC, so the Advanced Premium Tax Credit. Not everybody knows about this. This is specific to subsidized health insurance. So if you or someone you know receives Covered California subsidized health insurance, last year was a great year for them. Federal government completely gave a tax break for anybody that received it. If you received too much of that APTC, you weren't required to pay it back, which is how it would normally go. Yeah. So if you said, hey, I need $20,000 in tax credits this year for my insurance, and then you made too much money, the IRS will say, give us our 20 grand back because you didn't need it. Last year, they didn't say give us any money back. So anybody that received those big old subsidies didn't have to pay them back. And
Wait,
that was another one of those. Yeah.
Come on.
No, that happened last year. It
Some
was
of
a
those,
big
but
deal.
you're right. But some of those subsidies are massive. It's like people will, get out of paying, like you said, 20, 30 grand for their family of their health insurance if they show a low income.
Yep.
And you're saying they got out of that if they made money?
Yep. They got out of them completely. To turn it on its head even more, what happened last year was the federal government got rid of them completely. They said, you don't have to pay this back. And California stepped in and said, if your income was within these thresholds, you're due a little bit of a tax credit. So on some tax returns, people got a $20,000 reduction on their federal side, and also up to a $15,000 bonus on their state side. So we're talking about a 35 grand swing, from one way to the other, just because of how, poorly implemented that was.
Well, poorly? This sounds awesome. People are going to be really bummed doing taxes moving forward when things are back to normal.
Yeah.
There's not going to be nearly as many surprises this year, good or bad. Hopefully, as long as people are planning.
With murder here.
Yeah, last year was. I've never seen anything like it. I've talked to a lot of CPAs who said the same thing, that last year was just one for the books. Hopefully it stays that way. As far as APTC for 2021, right now there's no talk about them doing the same exclusion. If you receive too much, you're going to have to pay it back as of current date. California, same thing. They'll go ahead and step in if you received too much income and you're not eligible for federal. California has a higher income threshold just because we have a higher cost of living in this state.
Yeah, you would think though that this rule in general would just crush people who exaggerate facts trying to sign up for the health insurance subsidies and then find out later that they're totally askew.
No, this tax credit is it's dangerous, and they do a really, really bad job at explaining how it works when you're actually signing up for these subsidized health insurance.
Right.
But I've seen clients who claimed 25 grand of this APTC, and at the end of the year they weren't eligible for any of it. And all of a sudden you have to come up with 25 grand, right? Because the government's paid on your behalf that money, and they want it back. Yeah. So that's painful. Very painful. So if you're someone that receives APTC, doing some planning around that, just making sure that your income's about where you said that it was going to be, that's important to negate those big old payments. Definitely important. That one's scary. The last big change is the Child Independent Care Tax Credit. So the American Rescue Plan Act drastically expanded the Child Independent Care Tax Credit for 2021. And as of right now, this is only 2021. They haven't extended it as 2022. This is just for this year. In the past, the credit was worth about 20 to 35% of up to $3,000 in expenses. That's capped at $6,000 if you have 2 or more kids. The new credit changed those brackets from 35% to 50% of up to $8,000 per dependent and eligible expenses. So more than double the expenses, and the total percentage return is nearly doubled as well. AGI limits were expanded. More taxpayers are now eligible to take advantage of these credits for the 2021 tax year. So I'm expecting to put this credit on more and more returns for this year, which is exciting to me. This is a credit that people get. The child independent care credit is normally for if you have any sort of after school programs, or if you have to send your kid to a daycare throughout the day, or maybe they have summer camp and you need to send them to summer camp so that you can go to work. All of those things are eligible expenses for the child independent care credit. And this is a big deal. This is a direct credit right back to you. And also this is refundable. So we were talking earlier about refundable versus non-refundable. This credit is refundable. So even if you don't have a lot of tax liability, you can actually get some of that credit kicked back to you to help cover some of those expenses that you incurred.
So can I homeschool my kids and pay my wife to watch them?
That would be awesome.
No, you can't.
That's what we do here?
You can't pay any of your family members, unfortunately. It's got to be an established person that you're paying to watch your kids or daycare.
Tana, you're hired. We'll get you over here.
I'll set you up with an EIN.
I already have a job.
I'll split my credits with you.
No, but going back to the subsidized health insurance, one point that I thought about, because I've had clients call me and say that they have to now pay back money. One thing that I would recommend is if your employment changes, or if your husband gets like a contract or something where you didn't foresee this income coming in, you can always call Covered California and just let them know. Just say, hey, this is what I made, or this is what we're going to make. And then they'll readjust what you owe so that it's not just very painful at the end, when you have to file.
Yeah, no, that's very, very true.
But also don't BS it from the get-go.
Exactly.
Because everyone's like, well, I don't know. Look at if I made this much, I get a little break. Everyone wants to be
just
creative.
Be honest.
That's how life goes. Is everyone's creative in the moment of what's good for them.
Right.
They want to take early Social Security because what if they don't live forever?
Yeah.
It's just everyone suddenly rehashes thought. So don't be too creative.
No, but you're right. If your income is all of a sudden higher than you expected, definitely go in, change those numbers on the Covered California website. You're still probably going to owe back the first few months when you were making less than you expected, but at least it'll even out for the future.
Yeah, and less painful. Definitely.
Yes, less painful.
I think the theme, if I've heard some theme, is, when you get into some of this stuff, is evaluating your taxes as you go is very valuable, because if you're under withholding because of child tax credits, if you're making more money that could impact your subsidies, all of this stuff can be very detrimental and surprising at the last minute. Hence why preparing taxes is nice, but not always useful, right? Just getting your taxes done 3 days before tax season, you're just recording history. But considering them throughout the year, having a good tax professional that can help you make good decisions throughout the year and adjust as things change is huge.
Yeah. So I completely agree. Once you've passed that end of year date, 12/31, there's very little that can be changed on your return. So doing some proactive planning, it saves a lot of money in the long term. It's really good.
All right, children, I think we've done it. Thank you for being here. Connor, thanks for being here.
Yeah, that was fun.
Everybody, the good news is it'll just be Connor and Tana. That's coming.
Well, maybe we can think of something else that Connor can be on the show with as well.
Take over my
I just
slot.
like taxes. I just want to do taxes.
Lame. Anyways, if you have any questions, if you have any thoughts, don't hesitate to call us. 805-500-7035. Visit our main website, thelindgroup.com. We're here to help you with taxes, retirement, income planning. This is what we do. We can help you with this stuff. So don't hesitate to call, and everybody have a great week.